Just a few years ago, Canada's housing market looked unstoppable. Home prices were rising so fast that in some cities, houses gained more value in 1 year than the average Canadian salary. Between 2020 and 2022, home prices jumped nearly 4% across the country, creating one of the biggest housing booms in modern history. People rushed to buy homes, investors piled into real estate, and many believed prices would only go up forever. But today, something dramatic is happening beneath the surface, and many experts are warning that the market may be entering a dangerous turning point. Across Canada, the signs are becoming impossible to ignore. Mortgage payments have skyrocketed, sales are slowing, investors are pulling back, and thousands of homeowners are facing massive payment shocks as their mortgages renew at much higher interest rates. In some regions, home prices are already falling faster than analysts predicted, while new housing supply continues to grow. The question many Canadians are now asking is simple but frightening. Is Canada's housing market starting to collapse? In this video, we're going to break down the 10 powerful economic laws quietly reshaping Canada's real estate market right now. These forces are changing how buyers, sellers, and investors behave, and understanding them could help you avoid costly mistakes and see where the market might be heading next. Number 1. The law of interest rate gravity. For years, the engine behind Canada's housing boom was incredibly cheap money. Mortgage rates were so low that borrowing hundreds of thousands of dollars suddenly felt manageable for millions of buyers. When interest rates sit near historic lows, people can afford bigger loans, which pushes home prices higher and higher. But here's the reality many buyers didn't fully consider. Housing prices don't just rise on demand. They rise on borrowing power. And once interest rates start climbing, that borrowing power begins to fall fast. This is what economists often call interest rate gravity. Just like gravity pulls objects back to the ground, higher interest rates pull housing prices downward. A buyer who could comfortably afford a $900,000 home when rates were around 2% might only qualify for a $600,000 to $650,000 home today, with rates above 6%. That massive drop in purchasing power instantly shrinks the pool of qualified buyers. Fewer buyers mean less competition, and less competition often leads to falling home prices. The situation becomes even more intense when you consider mortgage renewals. Millions of Canadian homeowners locked in ultra-low rates during the pandemic. But as those mortgages expire, many families are now renewing at double or even triple their original interest rate. In some cases, monthly payments are jumping by hundreds or even thousands of dollars. That financial pressure forces some homeowners to sell, adding even more supply to the market. For buyers and homeowners, this law sends a clear message. Interest rates control the housing market more than almost anything else. Before purchasing property, it's critical to stress test your finances and ask a simple but powerful question. Could you still afford your home if interest rates stayed high for several more years? Before we move on, we'd love to hear from you. Do you think Canada's housing market will crash or recover soon? Drop your opinion in the comments. We read every single one. And if you appreciate the effort we put into breaking down complex topics like this, please subscribe to the channel. It's just one click, but it helps us keep creating these in-depth videos for you. Number 2, the law of overvaluation. During the height of the housing boom, something unusual happened in Canada's real estate market. Home prices began rising much faster than people's incomes. In many cities, the average home price climbed to 10 to 15 times the average annual salary. For comparison, economists generally consider a healthy housing market to have a ratio closer to 4 or 5 times household income. When prices rise far beyond what people can realistically afford, the market enters a dangerous territory known as overvaluation. Overvaluation doesn't happen overnight. It usually builds slowly during years of excitement, speculation, and easy credit. As prices keep rising, many buyers begin to believe that real estate is the safest investment possible. People rush to buy homes not just to live in, but to avoid missing out on future price increases. This mindset pushes prices even higher, creating a cycle where homes become less connected to their real economic value. But markets eventually face reality. When homes become too expensive relative to income, fewer new buyers can enter the market. Younger families struggle to qualify for mortgages. First-time buyers delay purchasing, and investors start questioning whether the numbers still make sense. When demand begins to slow while prices remain high, the imbalance becomes clear. Another way economists measure overvaluation is through the price-to-rent ratio. If the cost of owning a home is dramatically higher than renting the same property, investors may start pulling back because the investment stops making financial sense. As more people realize the numbers don't add up, the market can begin to cool quickly. The lesson from this law is simple but powerful. When prices move too far ahead of fundamentals like income and rent, corrections often follow. For buyers and investors, understanding this relationship can help prevent the costly mistake of purchasing property during a highly inflated market. Speech balloon quick question for you. If housing prices drop 20 to 30% tomorrow, would you buy a home immediately or wait even longer? Tell us your strategy in the comments. Your answer might spark a great discussion. And if you enjoy content that breaks down complex economic topics in simple ways, please subscribe to the channel. It's just one click, but it helps us continue creating these videos for you. Number 3. The law of speculative mania. Every major housing boom in history has one thing in common: speculation. At some point, the market stops being driven by people who simply want a place to live and starts being driven by people who want to make quick money. During Canada's housing surge, the shift quietly took place. Investors, house flippers, and short-term buyers began entering the market in huge numbers, hoping to profit from constantly rising prices. This is what economists call speculative mania. When speculation takes over, the psychology of the market begins to change. Buyers are no longer asking, "Is this home worth the price?" Instead, they ask, "How much will this be worth next year?" That single shift in thinking can push prices much higher than the true value of the property. In some Canadian cities, investors made up a large portion of home purchases. Many people bought second or even third properties expecting prices to climb quickly. Some buyers planned to flip homes within months, while others purchased properties hoping rental income would eventually cover the costs. As long as prices kept rising, the strategy seemed to work. But speculation is a double-edged sword. The same investors who push prices upward during a boom can also accelerate the decline during a slowdown. When investors sense that prices might stop rising, or worse, start falling, they often try to sell quickly to protect their profits. If many investors sell at the same time, housing supply increases rapidly, and that can place significant downward pressure on prices. This law teaches an important lesson. Markets driven by speculation are often unstable. When excitement fades and reality returns, prices can adjust much faster than people expect. For buyers and investors alike, it's important to remember that real estate should be viewed as a long-term investment, not a guaranteed short-term profit. Speech balloon, let's hear your perspective. Do you think investors are helping the housing market or making it more unstable? Share your thoughts in the comments. We read them all and love seeing the discussion. And if you appreciate the effort that goes into researching and explaining topics like this, please subscribe to the channel. It takes just one click, but it helps us keep creating valuable videos for you. Number 4. The law of debt saturation. One of the biggest hidden risks in Canada's housing market isn't just home prices. It's how much debt people are carrying to afford those homes. Over the past decade, Canadian households have accumulated some of the highest debt levels in the world. According to financial reports, household debt has climbed to more than 180% of disposable income, meaning many families owe nearly $2 for every dollar they earn. A large portion of that debt comes directly from mortgages. During the years of low interest rates, taking on large mortgages didn't seem dangerous. Monthly payments were relatively manageable, and rising home prices made homeowners feel wealthier on paper. But this created a situation economists call debt saturation, a point where households simply cannot borrow any more money without putting themselves under serious financial pressure. When a market reaches this stage, growth becomes much harder to sustain. New buyers struggle to qualify for loans because their debt levels are already high. Existing homeowners become cautious about taking on additional financial obligations. Banks also tighten lending standards when they see household debt rising too quickly. All of these factors begin to slow down housing demand. The problem becomes even more serious when interest rates rise. Higher rates mean larger monthly payments, and heavily indebted households suddenly feel the strain. Some homeowners may need to cut spending, delay investments, or even sell property to reduce financial pressure. When multiple households face this situation at the same time, the housing market can start to weaken quickly. The key takeaway from this law is simple. Debt can fuel a housing boom, but too much debt can also bring that boom to an end. For anyone entering the market, the smartest approach is to borrow cautiously, maintain financial flexibility, and avoid stretching your budget to its absolute limit. Speech Balloon, now we're curious. Do you think household debt is the biggest risk to Canada's housing market? Share your thoughts in the comments. Your perspective might help others see the bigger picture. And if you enjoy content like this, please subscribe to the channel. It's just one quick click, but it supports the huge amount of effort we put into making these videos. Number 5. The law of mortgage renewal shock. One of the biggest financial tests for Canadian homeowners is quietly approaching, and many people don't fully realize how powerful it could be. Over the past few years, millions of Canadians locked in mortgages during a time when interest rates were at historic lows. In some cases, homeowners secured mortgage rates close to 1.5% or 2%, making their monthly payments surprisingly affordable. But those ultra-cheap loans were never meant to last forever. As these mortgages begin to expire, homeowners are now facing what experts call mortgage renewal shock. Mortgage renewal shock happens when homeowners must renew their loans at much higher interest rates than before. Imagine someone who bought a home with a comfortable monthly payment of $2,000 during the low-rate era. When that mortgage renews at today's rates, sometimes above 6%, their payment could jump to $2,800, $3,000, or even more. For many households, that increase represents a serious financial strain. This issue becomes even more important when we look at the scale of the situation. Over the next few years, millions of mortgages across Canada will be renewing, and many homeowners will experience significant increases in their monthly payments. Some families may adjust by cutting expenses or extending their mortgage terms, but others may find the new payments simply too difficult to manage. When homeowners feel this kind of pressure, some may decide to sell their homes instead of renewing at higher costs. If a large number of properties enter the market at the same time, housing supply rises quickly, which can place downward pressure on prices. This is why economists are closely watching mortgage renewals. They could become one of the most important factors shaping Canada's housing market in the coming years. The lesson here is clear. Interest rates don't just affect new buyers. They can also reshape the financial reality of existing homeowners. Speech Balloon, let's make this interesting. If your mortgage payment suddenly increased by $1,000 per month, what would you do? Sell the house, cut expenses, or hold on? Share your answer in the comments. And if you value the research and effort behind videos like this, please subscribe to the channel. It takes just one click, but it helps us keep creating these deep dive insights for you. Number 6. The law of supply pressure. For years, one of the biggest arguments supporting high housing prices in Canada was simple. There weren't enough homes available. Limited supply and strong demand pushed prices higher and higher, especially in major cities like Toronto and Vancouver. But markets are constantly evolving, and today a new force is beginning to emerge: growing housing supply. This shift is what economists often refer to as supply pressure. During the housing boom, developers rushed to take advantage of soaring prices. Construction cranes filled city skylines as thousands of new condos, townhouses, and residential projects were approved and built. However, construction projects take years to complete. Many of the homes that were planned during the boom are only now entering the market, arriving at a time when demand is starting to weaken. When more homes become available while fewer buyers are able or willing to purchase, the balance between supply and demand begins to change. A few years ago, buyers were competing aggressively, sometimes offering well above the asking price just to secure a property. Today, in some areas, sellers are seeing fewer offers and longer listing times. This shift signals that supply pressure may be slowly building. The situation becomes even more interesting when investors are involved. Many newly completed condos were originally purchased by investors who planned to rent them out or sell them for profit later. But if market conditions weaken, some investors may decide to sell their properties sooner than planned. When many of these units appear on the market at the same time, supply increases rapidly. This doesn't necessarily mean prices will collapse overnight, but it does mean the balance of power may start shifting toward buyers. More available homes give buyers greater negotiating power, which can gradually push prices downward. The key lesson from this law is simple. When supply rises while demand slows, housing markets rarely stay the same for long. Speech Balloon, here's a question for you. Do you think Canada still has a housing shortage, or are we starting to build too many homes? Share your thoughts in the comments. We genuinely enjoy reading your perspectives. And if you appreciate the time and effort that goes into explaining these complex topics, please subscribe to the channel. It's just one click, but it helps us keep bringing you valuable content. Number 7. The law of investor exit. During the peak of Canada's housing boom, investors became one of the most powerful forces driving the market. Many people purchased properties not because they needed a place to live, but because they believed housing prices would continue rising rapidly. Some investors bought condos to rent out, others bought properties to flip for quick profits, and some simply held homes expecting long-term appreciation. As long as prices kept climbing, the strategy seemed almost unstoppable. But the housing market changes when investor confidence begins to fade. Investors are usually more sensitive to market conditions than regular home buyers. Unlike families buying a home to live in, investors are focused mainly on returns and profitability. If rising interest rates, falling prices, or weak rental incomes start reducing those returns, investors often become the first group to pull back from the market. This is what economists call investor exit. When investors stop buying, or worse, start selling, the market can shift quickly. A single homeowner selling a property doesn't usually affect prices much. But when multiple investors list their properties at the same time, housing supply increases rapidly. That sudden increase in available homes can place significant downward pressure on prices, especially in areas where investors own a large share of properties. Another factor pushing investors toward the exit is rising costs. Higher mortgage rates, property taxes, maintenance expenses, and stricter regulations can all reduce the profitability of owning rental properties. If rental income no longer covers these costs, some investor may decide that selling is a safer financial option. The lesson from this law is important. Markets supported heavily by investors can grow quickly during a boom, but they can also slow down quickly when investors leave. When the investment crowd begins stepping away, the housing market often enters a much more cautious phase. Speech Balloon, now we want your opinion. Do you think real estate investors are helping solve the housing shortage or making the problem worse? Drop your thoughts in the comments. We read every single one. And if you enjoy deep insights like this, please subscribe to the channel. It's just one simple click, but it helps support all the research and effort behind these videos. Number 8. The law of affordability collapse. One of the clearest warning signs in any housing market is when homes become so expensive that the average person can no longer afford them. Over the past decade, this problem has grown dramatically in Canada. In many major cities, the cost of buying a home has increased far faster than wages. While incomes have grown slowly, housing prices and mortgage payments have surged. This growing gap has led economists to describe the situation as affordability collapse. Housing affordability is usually measured by how much of a household's income goes toward mortgage payments. Traditionally, financial experts suggest that housing costs should stay below 30% of a household's income. But in many parts of Canada today, new home buyers are spending 40%, 50%, or even more of their income just to cover housing costs. When such a large portion of income goes toward housing, it leaves families with far less money for everyday expenses like food, transportation, savings, and emergencies. Rising interest rates have made this challenge even more severe. Higher mortgage rates mean that buyers must pay significantly more each month for the same property. A home that once required a manageable payment suddenly becomes far more expensive to finance. As a result, many potential buyers are stepping back from the market because they simply cannot qualify for the loans needed to purchase a home. When fewer people can afford to buy homes, housing demand begins to slow. Sellers may need to lower prices or offer incentives to attract buyers. Over time, this adjustment can bring housing prices closer to what the average household can realistically afford. The key takeaway from this law is straightforward. No housing market can remain strong if most people are priced out of it. Eventually, prices must adjust to match the financial reality of the people who actually live and work in the country. Speech Balloon, let's hear your perspective. Do you think home ownership in Canada is becoming impossible for the next generation? Share your thoughts in the comments. We genuinely enjoy reading your opinions. And if you appreciate the effort behind these detailed breakdowns, please subscribe to the channel. It's just one quick click, but it helps us keep making videos like this. Number 9. The law of economic slowdown. The housing market doesn't exist in isolation. It is deeply connected to the overall health of the economy. When the economy is growing, jobs are stable, incomes rise, and people feel confident about making major financial decisions like buying a home. But when economic growth begins to slow, that confidence can quickly disappear. This powerful connection is what economists refer to as the law of economic slowdown. During strong economic periods, people feel secure in their employment and future earnings. That confidence encourages them to take on long-term financial commitments, such as mortgages that last 20 or even 30 years. However, when economic uncertainty increases, whether due to inflation, rising interest rates, or global financial pressures, households often become more cautious with their money. When people worry about job stability or future income, they are far less likely to take on massive financial obligations. Instead of rushing to buy homes, many families choose to delay purchasing decisions and focus on saving money. This shift in behavior can significantly reduce demand in the housing market. Businesses also respond to economic slowdowns by reducing expansion plans or hiring fewer employees. If unemployment begins to rise, even slightly, housing demand can weaken quickly. Homeowners facing job losses or reduced income may struggle to keep up with mortgage payments, which can lead to increased property listings and additional pressure on home prices. Another important factor is consumer confidence. Housing markets rely heavily on people believing the future will be financially stable. When confidence drops, buyers hesitate, sellers become nervous, and transactions slow down. The lesson from this law is simple but powerful. Housing markets thrive during strong economic growth but often struggle when a broader economy begins to slow down. Understanding this relationship helps explain why economists closely monitor economic indicators when predicting housing trends. Speech Balloon, here's a question for you. If the economy slows down in the next few years, do you think housing prices will fall or stay strong? Let us know your prediction in the comments. And if you enjoy videos that simplify complex economic trends, please subscribe to the channel. It's just one click, but it truly helps us continue creating these detailed insights. Number 10. The law of market psychology. At the heart of every housing boom and bust lies something surprisingly simple: human psychology. While numbers like interest rates, income levels, and supply are incredibly important, the housing market is also heavily influenced by how people feel about the future. Economists call this forced market psychology, and it can sometimes move prices faster than any economic indicator. During a housing boom, optimism spreads quickly. People hear stories about homes doubling in value, neighbors making huge profits, and investors earning easy returns. This excitement creates a powerful emotion known as FOMO, the fear of missing out. Buyers rush into the market because they believe prices will keep rising. In this environment, even expensive homes start to feel like once-in-a-lifetime opportunities. But psychology works both ways. When the market begins to slow, the mood can change very quickly. Instead of fearing that they might miss out on rising prices, buyers begin to worry that prices might fall after they purchase. Suddenly, people become cautious. Buyers wait on the sidelines, hoping for better deals, while sellers become nervous about listing their homes. This shift in mindset can create a self-reinforcing cycle. When fewer buyers enter the market, homes stay listed for longer periods. Sellers may start lowering prices to attract attention. Those price reductions send signals to other buyers that the market might be weakening, which causes even more people to delay their purchases. History has shown that once market confidence begins to decline, housing markets can shift much faster than expected. The key lesson from this law is that real estate isn't driven only by numbers. It's also driven by human emotion, expectations, and confidence in the future. Speech Balloon, now it's your turn. Do you think Canada's housing market will recover soon, or are we just at the beginning of a bigger correction? Share your prediction in the comments. We love seeing your insights. And if you enjoyed this breakdown and appreciate the time and research we put into every video, please subscribe to the channel. It's just one click, but it helps us keep creating valuable content like this. When we step back and look at the bigger picture, it becomes clear that Canada's housing market isn't being influenced by just one problem. Instead, it is facing multiple powerful forces at the same time. Rising interest rates, high household debt, declining affordability, investor pullback, and changing market psychology are all combining to reshape the direction of the market. When several of these forces appear together, Housing markets often enter periods of major adjustment. This doesn't necessarily mean that the entire market will collapse overnight. Real estate tends to move in cycles, and every boom is usually followed by a period of correction or stabilization. In some cities, prices may fall more noticeably, while other regions could remain relatively stable depending on local demand, job growth, and population changes. But what many economists agree on is that the era of easy, rapid price growth may be over for now. For buyers, this changing market may actually create new opportunities. When competition decreases and sellers become more flexible, buyers gain greater negotiating power. Instead of rushing into bidding wars, buyers may have a chance to take their time, compare options, and make smarter financial decisions. For homeowners and investors, the key lesson is financial preparation and long-term thinking. Housing should be viewed as a long-term investment rather than a quick path to profit. Markets will rise, fall, and stabilize over time, but those who plan carefully and manage risk tend to navigate these changes more successfully. In the end, the future of Canada's housing market will depend on how these economic forces evolve in the coming years. And the people who understand these forces today will be better prepared for whatever happens next. Speech Balloon, now we'd really love to hear from you. If you had to predict today, where do you think Canada's housing market will be in the next 5 years? Share your thoughts in the comments. Your perspective might spark an interesting discussion. And if you appreciate the research and effort that goes into videos like this, please subscribe to the channel. It's just one click, but it truly helps us keep creating content like this for you.